Let's look at some US ETFs, and what I'm going to model is the 5-year compound annual growth rate, the volatility, divide one by the other, get the Sharpe ratio, which is return per unit of risk, look at the maximum drawdown of each ETF and the month's duration of that drawdown, and then the returns over maximum drawdown is in the next column. Then I rank it all, give it an overall score and an overall ranking. So we're going to start with the S&P 500, CAGR above 12%, which is good but possibly not sustainable in the long term. The volatility 14%, pretty good, so yeah, strong Sharpe ratio. The maximum drawdown is 13%. And yeah, that's pretty solid, but unfortunately the drawdown duration is 18 months, and that reflects the high that was achieved at the end of 2021, and we're getting near to a full recovery, but we're not there yet. So when I look at the rankings, it comes across overall as ranked number 6 of all the ETFs that I'm analysing here. This spreadsheet is available for purchase on eBay. I'll put a link in the description. And then next I look at various sectors. So let's start with information technology, which has a tremendous growth at over 20%, but again, I don't think that is sustainable. So if you do invest in that sector, there's a risk of getting a reversal, some mean reversion in the short term, so you've got to be quite careful with that one. So really good Sharpe ratio, drawdown 20%, so quite high, but the duration was only 16 months because it's now pretty much back to an all-time high. This one is ranking number 8 overall because of the way that I'm weighting things more towards drawdowns and being cautious as an alternative to the S&P 500 rather than just going straight out for growth. Now I'm looking at consumer staples, CAGR 11%, which is impressive, volatility 12%, which is good, maximum drawdown only 9.7%, so that's really good. It just gives me a lot of comfort that if I invest in this sector, then things are pretty stable, valuations don't get that carried away, and the drawdown duration is only 11 months. And actually this one is ranking number 1 across everything that I've analysed. And then number 2 is healthcare, which has a slightly greater growth rate, but a bit more volatile, and duration, maximum drawdown 11%, but duration only 8 months. So again, nice and solid. And the good thing about healthcare is that it's backed up by governments and insurers paying out on healthcare, and then also you've got biotechnology within there, so you do have a growth arm within that sector. I've also looked at what I'm calling other, so I've looked at the Nasdaq, where it's just not really performed as well as the information technology sector, perhaps because some of the IT sector is just on the New York Stock Exchange and not the Nasdaq, and maybe they're a bit more stable and more profitable. Also looked at this one, which is socially responsible index, this SUUS. It's outperformed the S&P 500 over 5 years, and it's ranked number 3 overall. So yeah, that one's got some pretty good stats. It has a bit more of a leaning towards things like technology and healthcare, and that's what's really helping it have some pretty good performance. Now we've got S&P 500 equal weight, CAGR about 10%, but the interesting thing here is that it's been really surprising how the largest companies in America have continued to grow so strongly when you'd think that they'd hit sort of market saturation and kind of things like this. And it's certainly possible over the next maybe 10 or so years that we could see a return to some of the more mid-cap stocks doing well, and then that would favour an S&P 500 equal weight ETF. And so one of the reasons why active funds have underperformed the S&P 500 is that pretty much none of them overweight the largest companies such as Apple and Microsoft, and if those two don't do so well in the future, then we'll probably see more active funds outperforming. So it's not really that the active fund managers are bad at what they do, it's just that by the nature of it, they're not really going to overweight the very largest companies. Now I've got some factor data. Quality factor has underperformed the S&P 500, which is a bit of a shame, because you would have thought that if you ignore some of the dross, you get better returns, but actually the results here have been pretty mediocre. But the worst performing, what I'm calling factor, is high dividend, low volatility, which has a really poor compound annual growth rate. So I don't know quite what's going on there, but that one is the worst of the ETFs that I've been analysing. Minimum volatility, this tends to favour things like consumer staples and healthcare, possibly things like utilities as well. Growth rate nearly 10%, so yeah, that's pretty good. And overall, that one is ranking number 5 of all the ETFs. Next up, I've got some ETFs focused solely on income, and here the problem has been that they've sacrificed price returns at the favour of income. So although this is just the price performance, and a lot of these are accumulating ETFs, so they will actually roll up the dividends. If it's a distributing ETF, an income ETF, then it will slightly underrepresent the performance. But here stats really aren't very good. So I'm a bit wary of people that just solely talk about income. I think you need to put more screening on what you're doing when you're looking at income exchange traded funds. So now if we look at things like Dividend Aristocrats and Quality Dividend, growth rates of about 7 and 5.6%. So performance is fairly average, really. I mean, you've got another couple of percentage points to add on for the dividends that you would receive, but overall, on terms of things like maximum drawdown and drawdown duration, I think you could do better than these. And so what we've got here is what I'm saying are the best ones, and it's really between the WisdomTree US Quality Dividend Growth, and we've looked at the global variant of this fund. I'll put a link in the description to that, and then there's also this Fidelity US Quality Income as well. This is in accumulation and income variance, so because the yield's about 2%, that explains the difference in the growth rate here. So CAGR nearly 12%, so very impressive. What I admire most is the low drawdown duration for the WisdomTree ETF, where it's only spent at most 6 months away from its all-time high over the last 5 years. So if you're holding it and then looking to sell it down in retirement, the chances of you seeing it way off its high, if you only want to take money once a year, are pretty low. So for that reason, I think it's worthwhile looking at these two in a bit more depth and just finding out what they're all about and how we can choose between them to maybe find out which is the best of these two. Here we have the holdings of both the Fidelity and the WisdomTree ETFs. The Fidelity has about 115 holdings. The weightings are more akin to market capitalization, whereas WisdomTree is weighting a bit more on dividends paid, and it has more holdings at 290. Fidelity is coming in slightly cheaper at 0.25% in fees compared to WisdomTree's 0.33% in fees. And there's some interesting differences between the two. WisdomTree has Cisco in it, which has increased its dividends every year since 2011, but that one is missing from Fidelity. And then Fidelity has things like AbbVie in it, which is missing from WisdomTree. And WisdomTree has a momentum filter that might have filtered out AbbVie. We also look at the sector exposure. The Fidelity sector exposure is very similar to the S&P 500 overall, whereas WisdomTree allows itself to deviate from that, so it's slightly overweighting information technology and consumer staples. WisdomTree give you a few more bits of data in terms of price to earnings ratio of the fund, which I quite like because you can then monitor that over time to see whether it's cheap or whether it's expensive. The Fidelity fund has about 1.2 billion assets under management, and WisdomTree is smaller at just under 0.5 billion. For further research, the first place to go would be the fact sheet of the ETF, which you can download from a website such as justetf.com, and the fact sheet gives a lot of just basic information about the ETF and its holdings, and you've got some things on the strategy here. So for WisdomTree, it's talking about ESG, and it's talking about liquidity requirements and the dividend requirements as well. Then also you can research WisdomTree on its own website, where it's got a lot more information about the strategy and about quality and about the defensiveness of the ETF and how it sees that ETF sitting in a portfolio. And then finally, if you're really interested, there is an index document that's about 100 pages long that goes into a lot of detail about the ETF. So here are the charts of the S&P 500, the WisdomTree Quality Dividend ETF, and the Fidelity US Quality Income ETF. And as you can see, they're all actually very similar, but the S&P is more volatile, as you can see, where it makes the highs here and then comes back down again. Of the three, I'm a little bit torn as to which one to really go for. I'd probably prefer the WisdomTree ETF because I do prefer some of the screening that it's using and the documentation that it gives behind it all. However, Fidelity are more established and they do have a lower expenses ratio. I'm slightly leaning towards WisdomTree because I do feel it does have lower duration of drawdowns, and that's really what I'd like. As I get older and am more likely to access the money, I'd feel more confident that the filters it applies will be more helpful for me in understanding the holdings, in avoiding low quality, no dividend paying rubbish, and also avoiding things like yield traps and companies with poor returns on capital employed. So I hope you've enjoyed the video. Subscribe, give it a like, and let me know any comments.